Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. A host of high-value deals, including the ones sealed by Adani Group and HDFC Bank, were the highlights of 2022. It was the year when India Inc. clinched its highest ever mergers and acquisitions, beating the previous record set in 2021 by a considerable margin. So what were the factors that led to this year's stellar numbers? And how will 2023 play out? Here's Bhashwar Kumar's report.
Aided by the $57.8 billion merger of HDFC Bank and HDFC, India Inc. reported its highest ever mergers and acquisitions in value terms in the calendar year 2022 at $171 billion. The year before, deals worth $145 billion were announced. Before 2021, the previous record was set in 2018 at $129 billion. Compared to 2018, the years 2019 and 2020 saw a fall in M&A deals in value terms. So, what changed in 2021 to arrest the M&A decline and break the 2018 record? According to professional services firm Bazar and Associates, disruptions caused by the COVID-19 pandemic accelerated the acquisition trend in India. Companies took the acquisition route to pursue accelerated growth. Moreover, buoyant cash reserves, FDI inflows and low interest rates allowed the corporate sector to realize a greater deal momentum. Consider the stellar rise in corporate earnings in FY21 and FY22. The combined net profit of India's listed companies jumped 63.5% year-on-year in FY22. The 955 non-financial companies in Business Standard sample had reported a combined net profit of $86.7 billion in FY22. compared with $53 billion in FY21 and $31.3 billion in FY20. Overall, annual corporate earnings rose 66% from the pre-COVID level of $52.2 billion in FY19. This would have left companies with considerable firepower to deploy for mergers and acquisitions throughout 2021 and 2022. Many companies also instituted cost cuts to reduce overheads and increase efficiency in 2020. This led to a high availability of cash with these firms. Meanwhile, many companies which were unable to cope with the impact of COVID were either looking to get out or searching for an entity to take over their business. These factors have also encouraged the cash-rich among India Inc.'s companies to expand and eye inorganic growth. A report by consulting firm Bain & Co. said that the appetite of Indian companies for acquisitions had increased post-COVID. That was towards the end of 2021. The report cited business disruption triggered by COVID as the driver for Indian firms to transform their businesses through M&As and asset sales. This was evident by the M&A activity in India hitting the then all-time high in 2021. The report had said that the acquisition activity was expected to continue in 2022. The report also outlined major themes that were driving the acquisition activity. There was the democratization of M&As, with 2020 and 2021 seeing more first-time buyers than ever before. The other major theme was that more M&As were focused on transformation rather than scale. The report said that scope deals, which are acquisitions outside a company's core business, steadily grew their share in deal volume. In fact, in 2021, scope and capability deals accounted for 4 out of 10 transactions. They often followed disruptive themes such as digital and renewable technologies. According to Bazar and Associates, the trend of companies opting for scope acquisitions continued in 2022, becoming one of the factors driving the record M&A deals value. However, it also cited scale acquisitions as another driving factor. Consider that in 2022, the acquisitions of Adani Group across cement, media and ports dominated the headlines. The conglomerate made its foray into the cement sector by buying Swiss materials firm Holcim's stake in Ambuja Cements for $6.5 billion. The group also acquired Israel's Haifa port for $1.18 billion and media firm NDTV this year. Indian companies also became aggressive in overseas acquisitions. Biocon Biologics, a subsidiary of Biocon, completed the acquisition of Viatris's global biosimilars business in a part equity, part cash transaction worth $3 billion. While M&A activity experienced a significant slump in the US, Europe, and Asia Pacific markets, India defied the global downward trend in 2022. According to a report by financial solutions provider Refinitiv, India was the only global outlier in this regard. In private equity-backed M&A activity, India even crossed China for the first time since 2008. In 2022, the financial services sector accounted for the highest share in total M&A deals, valued at $69.4 billion. Meanwhile, the high-tech sector accounted for the highest deal volume, with its deal value totaling $18.6 billion. Startup deals also drove M&A activity in 2022. A report by Grant Thornton Bharat indicated that during the first 9 months of 2022, startup M&A deal volumes surged 55% over the same period in 2021. The reason for this was the funding winter that adversely affected Indian startups. We also reached out to experts for their view on what 2022 meant for India's deal-making ecosystem.
Yeah, M&A in 2022 saw unprecedented deal activity. It was primarily driven by domestic M&A. So we really saw the confidence of India Inc. During the last calendar or the ongoing year, where, because of strong balance sheets, focus inwards, good profitability, I think large Indian corporates were buying businesses and were consolidating businesses. Cross-border M&A was, pretty range bound like 2021. Where inbound and outbound was, largely muted during the year.
We need to step back a bit and see 2021. I think deal activity witnessed a record high in 2021, surpassing the pre-COVID levels, fueled by cash reserves, PE dry powder, FDI, and low interest rates. The flurry of this deal activity continued well into the 3 quarters of 2022.
Bankers that Business Standard spoke to for a previous report said that M&As would build on the momentum seen in 2022. And were expected to be robust next year. They also said that in 2023, significant action was expected in the domestic market, even as cross-border acquisitions would see a slowdown due to fears of a recession. According to them, domestic M&As would be led by consolidation in the new age technology space, where a significant number of players would be forced to go the M&A way given the continuing funding slowdown. The bankers also said that the sale of the government stake in Concord and IDBI Bank would be the most watched deals in the first quarter of 2023. Against this backdrop, how do experts see 2023 playing out?
I would expect 3 primary drivers for the coming year. I think domestic M&A consolidation would be the headline theme again in the coming calendar. However, on the manufacturing side, the capex cycle is expected to really come back, and due to which you would see increased deal activity with global players looking at India, and that should hopefully drive inbound deal activity into India. So you would see a fillip on that side. On the private equity side, they're sitting on, I would say, unprecedented levels of dry powder, and that dry powder has to be deployed.
We have seen somewhat a slowdown in the third quarter of 2022, which is because of the global uncertainties such as supply chain problems, geopolitical instability, rise in inflation, rise in interest rates, volatile capital markets, and fear of global recession. Investors are unlikely to make large investments until these conditions stabilize. These are likely to continue well into the year 2023. But for 2023, there is an expectation that diversification and movement of multinational companies away from China and into India will give a fillip to the M&A activity in India. Also, digital transformation and energy transition are going to be key drivers of economic deal activity.
The year 2023 will likely see robust deal values and volumes being clocked. However, a lot will depend on the quantum of the impact that the projected global recession will have on India by the time the third quarter rolls in, and how well it weathers the storm thanks to its strong economic fundamentals.
Several Indian states are now rolling out the red carpet to India Inc. for investment. Some of them, like Punjab and West Bengal, need it more than the others. An RBI report recently highlighted the grim fiscal condition of 10 states, and of them, 5 seem to be in dire condition. So what ails these states, and what can be done to revive their economy? Is giving them power to levy income tax an answer? Tushar Verma spoke to experts to find the answer.
Expectations are running high as the Narendra Modi-led government is going to table its last full budget in a few weeks from now. Suggestions from the industry and various other quarters are pouring in. But unlike that of the centre, states' financial position hardly attracts attention, although they have not been doing great. The tax revenue of some state governments have been declining, making them more dependent on the central government. So, is it time for states to levy their own income tax? First, a bit of background. In June this year, against the backdrop of the financial crisis in Sri Lanka, India's central bank had come out with a report highlighting the fiscal vulnerability of some states. The Reserve Bank of India (RBI) flagged high debt levels of 10 states. It said that of all the tax collected by the state governments across the country, these 10 debt-laden states account for more than 50% of all tax collection. And this majority share in state tax collection by the 10 states has made public debt a fiscal risk for the country. And of these 10 states, the RBI identified Bihar, Kerala, Punjab, Rajasthan, and West Bengal as highly stressed, saying that they could face a crisis if they fail to curb non-merit expenditure. The debt growth in these 5 states has outpaced their gross state domestic product growth. The pandemic also exacerbated the problem. In November 2022, Business Standard reported that the gross fiscal deficit of states had grown to a whopping 79% after lockdown. The RBI report also said that these states spend 80 to 90% of the revenue on operational expenditure to keep the government running. It also included expenses that have short-term impact and do not lead to creation of any tangible asset. It leaves little room for capital expenditure. States earn through tax collection, non-tax collection, and from central transfers, which includes both tax sharing by the central governments and grants. Tax revenue may include excise duties, property and land tax, and entertainment tax. Non-tax revenue, on the other hand, includes capital appreciation and dividend from state PSUs. A big chunk of states' revenues come from central government's devolution in form of state GST, other taxes and grants, but the tax revenue of some of the state governments has been declining over the years, which has made them more dependent on the central government. So, is it a cause of worry?
It's a puzzle that especially when there is an increase in the devolution, increasing from 32 to 42%, and coinciding with the deterioration of the fiscal conditions and among the states. Why the states, when they're getting more untied grant, why should their fiscal situation deteriorate? So I think we need to get the answers on that. So what's happening right now is many states are actually getting into revenue expenditures which are not sustainable, right? And it is not really helping to create capital assets, rather it is more of a transfer, which is not going to create any kind of a output. I think that is the crux of the story right now.
States have long been demanding a higher share of tax collection by the centre. According to the latest Finance Commission recommendation, states should receive at least 41% of all tax collection by the central government. But in the last 5 years, devolutions by the centre have ranged between 32 to 37%. It was only in fiscal year 2020 when the share touched 41%. Of all the tax collected by the central government, cess collection is exempt from sharing. The Article 271 of our Constitution specifies this. Interestingly, since 2014 when Narendra Modi came to power, the share of cess in tax collection has gone up from less than 6% to about 20%. This means that the central government is not bound to share 20% of its revenue collection with states.
All cesses and surcharges are non-shareable. And what has happened over the last several years is that the center has not raised the base tax rates In fact, it has lowered the base tax rates in some cases, but has raised the cesses and the surcharges. So if you like, for instance, an income tax, you have all kinds of surcharges that are put on depending upon your income level. Those are non-shareable. And those get in a huge amount of money, right? So what the center is doing is essentially taking advantage of a constitutional loophole to reduce the state share and keep more for itself.
Budget data shows that the gap between net transfers and tax transfer from the center to the states has widened over the years. In 2021 to 22, tax transfer from the center amounted to 8.82 trillion rupees, while net transfer for the same period was almost double at 17.4 trillion rupees. In the first year of the Modi government in 2014 to 15, tax transfer was 3.38 trillion rupees and net transfer was 6.75 trillion rupees. This was a gap of 3.37 trillion rupees. A widening gap suggests an increase in discretionary transfers by the center. By definition, discretionary transfers may not be as transparent and can even lead to allegations of favoritism. Since taxation opportunities for state governments in India are limited, will it be a good idea if they levied their own income tax? Such a change will require a constitutional amendment that requires 2/3 majority in both the houses. It will then have to be ratified by more than 50% of all the state legislatures.
Well, that is problematic. I mean, there is a reason why the Constitution reserves the income tax for the center. And that is that income can be generated in one location and the person can be physically located in a different location altogether. For instance, the income that a person makes on, let's say, the share market, the income is being generated in, let's say, Mumbai, but the person may be staying anywhere in the country. So who levies the tax? Where is the jurisdiction? Given that our constitution mandates that people can move wherever they want in the country and that people can earn from whatever sources they like, having a state-level income tax is problematic.
While state-level income tax may not be a good idea, states can improve their fiscal condition by improving expenditure practice. The creation of capital assets has a long-term positive impact, and leaving room for it may decrease debt growth.
Moving on, equity markets were hit by bouts of volatility in 2022 as geopolitical tensions and drying liquidity dented sentiments. In our next report, Nikita Vashisht brings you key factors that will shape the markets in the year ahead. Central banks worldwide have been in firefighting mode since May 2022, just a couple of months after the Russian invasion of Ukraine. For the first time since 2008, the US Federal Reserve raised key rates as inflation flared up to decadal highs amid clogged supply chains. The Fed's response nudged other global central banks to follow suit. Back home, the Reserve Bank front-loaded a repo rate hike of over 200 basis points. This fierce fight to tame inflation hammered equities during the first half of the calendar year as it turned the liquidity taps off. Key indices like Dow Jones, Nasdaq, Nikkei and Kospi have lost considerable ground this year. By comparison, domestic frontline indices S&P BSE Sensex and Nifty 50 have fared better. According to Axis Securities, calendar year 2022 was a transition year, exhibiting liquidity reversal, policy tightening, geopolitical concerns, and a rising inflationary scenario which led to higher commodity prices for the first half of the year. Going into 2023, analysts believe a large part of the calendar year will be guided by interest rate decisions of the US Fed and the RBI, besides the intensity of inflation. Devang Mehta of Centrum Wealth elaborates on the same.
US federal terminal funds rate. US federal funds terminal rate again is very important to monitor. The trajectory of inflation and hence interest rates across the globe, how it worries the central banks and how do they respond is one factor that again will be taken forward in 2023, at least for the 6 months. First 6 months, that's a crucial thing to watch. Opening up of China is very important for global trades to realign again. That's also one monitorable. Secondly, I think the flows of foreign institutional investors into developed markets and emerging markets, how they pan out, that's also one thing which one needs to watch as a crucial factor. Surprisingly, in the last 3-4 years, Indian investor has come to the fore. Indian retail investors also started to invest dominantly in the markets, and SIP figures of around 13,000 crore. The last figure is quite a handful in terms of being a cushion if FIIs are again sellers. So that's also very crucial. India's macros and micros, the growth trajectory that India is going through, we are going to be the fastest growing nation. The estimates suggest around 6.5% type of growth, at least in the next 1 year. That's also very crucial to monitor. High frequency indicators, bank credit growth, GST collections, direct tax collections, this all have generally been robust. So that's also one thing that will keep markets and economy sort of excited. The private corporate capex along with the public government capex has also come to the fore in the last, I think, 1.5 year. This brownfield and greenfield project, how they pan out and how the private sector stays sort of in capex mode, that's also one important thing. One important factor that we always normally generally discount is the budget, the union budget, I think, which is just around 1.5 months away in January. That is going to also be a crucial factor for the medium term for the market. Why? Because this is the last sort of a full budget for this government before the 2024 election code of conduct sets in, and it will be more a vote of account, the 2024 one. So this budget again assumes importance. The trend of monetary policy in India is also something which one will sort of watch. As I also talked about macros, the micros earnings growth is going to be very crucial because almost the consensus talks about mid-teens type of earnings growth for the next couple of years. So by no way we are cheap, but again, as I said, more so if the earnings trajectory starts to sort of improve and scale up, India will be in a good position probably to attract a lot of inflows.
As economic fundamentals and liquidity flows will likely determine the market trend, Nitin Raheja of Julius Baer India warns that the re-emergence of fixed income as an asset class in a rising interest rate scenario could see some fund diversion from equities to debt, impacting domestic flows into equity mutual funds. Over the next few months, analysts say higher interest rates and slow recovery in consumption of low-income households, coupled with related derating in multiples of growth stocks, could be the key theme for the market in the first half of 2023. Today, the markets are likely to remain range-bound amid the expiry of future and options contracts for the December series. However, stock-specific action will continue. Weather outside the 8-block-long Wall Street is also grim, as the New York governor has issued another set of warning over extreme cold. The US and Canada are weathering a powerful Arctic winter storm. Scores of people have died, thousands of flights have been cancelled, and travel bans have been imposed in some parts. News reports are now citing terms like Arctic blast and bomb cyclones. We decode it for you in our next segment.
Vast swaths of the US and Canada are draped in a white sheet, but people are hardly venturing out to enjoy the snow. In fact, they are detesting the weather. Both the countries have been facing winter-related extreme weather conditions. The northwestern part of New York, especially the city of Buffalo, is bearing the maximum brunt. People in the city are living in a state of emergency, and millions are without electricity for the last few days. But what led to this? A combination of two phenomena called Arctic blast and bomb cyclones is said to be behind this extreme weather. Extreme cold air of the snow-covered Arctic region, supported by the jet streams, comes down to the relatively warmer regions and drops the temperature significantly. This phenomenon is called Arctic blast. But the situation in the Great Lake regions and other plain areas of the US has been created by the bomb cyclone. that was triggered by the Arctic blast. Bomb cyclone is dumping heavy snow and rain on several parts of the US and Canada. But what is it? A wind originates when there is a pressure difference between the adjacent air masses. The higher the pressure difference, the higher the intensity of the wind. In some situations, dry air from the stratosphere flows into a low pressure area. This makes the air within the depression to rise quickly and increase its rotation. The rotation further deepens the pressure and creates a vigorous storm. This phenomenon is known as explosive cyclogenesis. It is also referred to as a weather bomb or a bomb cyclone. While in western New York, the bomb cyclone intensified because of the lake effect. The cold air moves through the long stretches of warm water bodies of the Great Lake region. The lower layer of the cold air comes in contact with the surface of the relatively warm water surface. This causes evaporation of water and allows the air to absorb moisture along the way to create storms. This effect caused harsh conditions in places like the city of Buffalo. The bomb cyclone and similar extreme storms happen over the water bodies, as it has the water vapors to feed the storm. But along with the presence of Arctic blast, it gets even more severe in effect. The US media has called the ferocities of this storm worse than that of the blizzard of 1977. It has been reported that people who were traveling got stuck in the snow, and US authorities have put travel bans in several regions. The majority of the deaths, according to the authorities, have happened due to cardiac arrests that originated from the shoving and plowing of snow.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In some parts of the United States, mercury has plummeted as low as -50 degrees Celsius. It is enough to cause frostbites within minutes. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.